Hi, my name is Michael Carbone, and the purpose of this video is to help pre-retirees focus on what truly matters when it comes to their Social Security benefits. Your Social Security benefits will likely play a major role in your retirement as they will pay for a good chunk of your living expenditures while also offering protection from the rising cost of goods and services. The same cannot be said for most other lifetime incomes, which makes it all the more important to get Social Security right. The program as a whole can be complicated, and as a result, it can be very easy to get lost. So, while I do believe that it's important to educate yourself on all the topics relating to Social Security benefits, it's also important to not lose sight of what affects you the most because there are only so many variables that will affect you specifically. In this video, I'm going to help pre retirees zero in on what they need to know about their Social Security benefits. More specifically, in this video, we'll review the different types of Social Security retirement benefits, the two need to know Social Security topics about how your benefits will be calculated, the taxation of your benefits, and the potential implications of working after you file, key considerations for making an informed Social Security decision, and finally, the future of the Social Security program and how to prepare for potential future policy changes when you're making retirement decisions. There are generally four types of Social Security retirement benefits. In any case, you are filing for benefits under somebody's earnings record, which is another way of describing your historical wages. Depending on the situation, you can either file for benefits on your own record, your spouse's record, your ex-spouse's record, or your late spouse's record. You can only ever receive one benefit. In addition to these benefits, there are also benefits which may be available to dependents, but since this website is tailored towards pre-retirees, these won't be discussed. To discuss how Social Security benefits work, we'll generally do so in the context of somebody who's filing under their own earnings record, because this will ultimately be the foundation for the other types of benefits. The amount you will receive from Social Security will ultimately depend on two variables. The first is how much you've earned during your working years, and the second is the age that you begin receiving your benefits. There are two definitions that must be understood in order to understand how your benefits will change under different filing scenarios. The first is your primary insurance amount, or your PIA, and the second is your full retirement age, or your FRA. Your primary insurance amount is ultimately calculated based on how much you've historically earned and paid FICA taxes on. If you're running projections on Social Security's website, they will extrapolate your current earnings to determine this amount. Your PIA is the amount of income you'll be eligible to receive if you wait to file at your full retirement age, or your FRA. We'll discuss this next. You can think of your PIA as your base benefit. Everything will be adjusted based on this benefit, and the other types of benefits will also be calculated based on this benefit. Your PIA is calculated by taking an inflation-adjusted average of your highest 35 years of historical earnings that you've paid FICA taxes on. Once your adjusted average earnings have been calculated, they'll then run the average through a formula which then determines your PIA. This formula is beyond the scope of this presentation, and I really don't think that understanding it will help you make a decision that's better or worse. What you need to understand is that they're calculating this based on your historical wages, so you should be creating an account and generating a statement to ensure that all of your reported income is complete. From there, you might explore how potentially working longer and earning higher wages may permanently increase your lifetime benefit. So your earnings record will determine your base benefit, but the age that you file will determine how your benefit will be adjusted. Your full retirement age is the age that you will be eligible to receive your full retirement benefits. This is determined by the age that you were born, and it will serve as the base for adjusting your PIA depending on when you file. It's actually quite simple. As it stands, your FRA will fall somewhere between the ages 66 to 67, depending on the year that you were born. The closer your FRA is to 67, the later you can begin collecting your full benefit. You can generally begin collecting benefits as soon as the age of 62, but your benefits will be permanently reduced for each month that you collect before reaching your full retirement age. The most that your benefits can be reduced by is 30%, but this will depend on when you were born. For example, if somebody with a full retirement age of 66 collects at the age of 62, their benefit will be permanently reduced by less than somebody whose full retirement age is 67. And this is because their penalty will be calculated using a greater number of months. Alternatively, you can delay collecting benefits until the age of 70. By delaying benefits, you'll earn delayed credits, which will permanently increase your benefit base for each month that you delay after reaching your full retirement age. Again, the extent of your increase will vary depending on your full retirement age. If your full retirement age is 66, you can potentially increase your benefit by 32%, whereas if your Full retirement age is 67, you could only earn 24% because you'll have 12 months less of delayed credits to earn potentially. All right, so in summary, you need to know your primary insurance amount, which is your base benefit and will be calculated based on your earnings history, in addition to your full retirement age, which will be considered as the base from which your benefits will be permanently reduced or increased depending on the age that you file. If you haven't already, it's extremely important that you make an account on Social Security's website, ssa.gov. Your historical wages should already have been reported directly to the Social Security Administration, so you can easily make an account to see what your benefits are actually projected to be. This is what your statement will look like. So in this case, this person's full retirement age is 67 years old, and they're projected to be eligible for a benefit of $3,500 per month at that age. If this person takes their benefit early, the chart shows how their benefits may be reduced and vice versa. An important side note is that this chart will always be expressed in today's dollars. So in reality, these numbers will likely be higher when you actually begin collecting your benefits. This is because your benefits are inflation adjusted, which likely makes them your most powerful source of retirement income. Okay, so now moving on to spousal benefits. If you're not married, then feel free to skip to the next section. But for those who are, you may be eligible to collect your Social Security benefits based on your spouse's earnings history. The amount that you'll receive from Social Security under spousal benefits will depend on two variables. One, your spouse's primary insurance amount, and two, the age that you begin receiving your benefits in relation to your full retirement age. To be eligible for spousal benefits, you must be at least 62 years old, have been legally married for at least 1 year, and your spouse must already be receiving their own benefit. The most that you can receive from a spousal benefit is 1/2 of your spouse's primary insurance amount. So it would only make sense to collect the spousal benefit if 1/2 of their primary insurance amount is greater than the primary insurance amount that you would receive on your own earnings record. So we know that in order to receive a spousal benefit, your spouse must already be collecting his or her own benefit. But that doesn't mean that you can't collect your own benefit in the meantime. In this case, if you file before your spouse, but the spousal benefit will be higher, your benefits will increase to the spousal benefit once you become eligible when your spouse files for his or her own benefits. But that doesn't mean that your benefit won't be reduced if you file before reaching your full retirement age. So this type of filing strategy may not be appropriate unless your situation is unique, where you've reached your own full retirement age, but are waiting on your spouse to file. That way you can receive your own lower benefit and still get the spousal increase once they file for their own benefits. If you're divorced, you may be eligible to file for benefits on your ex-spouse's earnings record. Similar to spousal benefits, this would only make sense if your own benefit is less than 1/2 of your ex-spouse's primary insurance amount. To be eligible for divorcee benefits, you must be at least the age of 62, have not remarried, had been married to the ex-spouse for at least 10 years, and here's the tricky part, your ex-spouse must have already filed for his or her own benefit unless the divorce occurred over 2 years prior to when the application is being filed. These benefits are otherwise very similar to spousal benefits previously addressed. And finally, if you've become widowed, you may be eligible to receive survivor benefits. This is an important consideration for couples who have different levels of benefits and are considering when each spouse should file, but we'll discuss this in greater depth later on in the video. To be eligible for survivor benefits, you must have reached at least the age of 60. But it's important to note that although widows may claim their benefits as soon as the age of 60, the benefits will be permanently reduced. Also, the marriage must have lasted for at least 9 months, unless the death was due to an accident, in which case an exception would be made. Also, if the widow remarries before the age of 60, the survivor benefit would be nullified. Assuming that the widow waits until their full retirement age and their own benefit is less than their late spouse's full benefit as of the time of his or her death, they will receive the late spouse's full benefit. In the event that the widow is already collecting their own benefit, but the survivor benefit is higher, they will inherit the late spouse's benefit and their own will drop off. Okay, so now that you have a solid understanding of the different types of benefits and how much you might receive, let's review how your benefits may be taxed and the potential consequences of earning wages alongside Social Security income. So how will your benefits be taxed? Social Security is generally considered as taxable income for most people, but it's of course more complicated than that. In the context of your federal income taxes, Social Security will only be partially taxable, and this will depend on how much other income that you have. To determine how much of your benefits will be taxable, Social Security will calculate what's known as your provisional income. This is the sum of 1/2 of your Social Security benefits, other income, and municipal bond interest. For 2023, if your provisional income is less than 32,000 or 25,000 for single filers, then none of your benefits will be taxed for federal income tax purposes. If your provisional income is greater than 32,000 but less than 44,000, then half of your benefits will be taxed for federal income tax purposes. And finally, if your provisional income is greater than 44,000 or 34,000 for a single filer, then 85% of your benefits will be taxable. This is the greatest percentage of your benefits that can be taxed as of today. It's important to keep this in mind when you're making decisions in retirement. For example, if you realize a gain or distribute money from an IRA, you may trigger greater taxes owed on your Social Security benefits. On the state level, taxes will vary from state to state. There are generally no other income taxes that are paid in Social Security retirement benefits, but don't be alarmed when your Medicare premiums are docked from your Social Security check. All right, so moving on from taxes, if you continue to work after you started receiving benefits, your benefits may be reduced. Here's how that works. If you're receiving Social Security benefits and you're working and you're under your full retirement age, your benefits will be reduced by $1 for every $2 earned above the stated limit for that year. Now, if you're receiving benefits and you're working and you're the age of your full retirement age, your benefits will be reduced by $1 for every $3 that's earned above the slightly higher stated limit for that year until 1 month before you've reached your full retirement age. All right, so now moving on to the good stuff. What should you be considering when you're deciding on when to file? So generally speaking, I believe that you should first be looking to hedge longevity. Social Security is one of the very few sources of lifetime income that will rise with inflation. That is extremely valuable. So particularly for those who may be pushing their money or at risk of running out of money during their lifetime, ensuring that they have the greatest income during their later years should be priority number one. How can you do this? The easiest way to do this is to conduct a break-even analysis. Put simply, a break-even analysis will give you an idea for what age you'll have to live to in order to collect more benefits cumulatively for one filing age versus another. For example, if you're comparing a scenario where you file at the age of 62 versus if you were to wait until you were 67, in most cases, you would need to live at least into your late 70s to benefit more from waiting until the age of 67. Of course, another consideration would be whether or not you're married. If you are married, it's incredibly important to consider how spousal and survivor benefits may affect your total family benefits over each of your lifetimes. In the case where spousal and survivor benefits are an important factor in your retirement planning, it may be wise to prioritize the protection of the longest living spouse. Another important consideration would be whether or not delaying your benefits may offer you attractive tax planning opportunities. If you have assets that are saved outside of retirement accounts, you may be able to spend this money to pay for your living expenditures while implementing Roth conversions or realizing taxable gains at 0% during the years that you're delaying. Let me expand on this. If you stop working and delay your Social Security benefits, you may have several years where you'll have zero or even negative taxable income. This may give you an opportunity to take pre-tax retirement money and convert it to tax-free Roth money and pay taxes towards the bottom of the federal income tax brackets. You may also tap pre-tax retirement accounts at low rates during low-income years, meaning you can spend pre-tax retirement money and pay very little in taxes versus when you have to begin spending this money when you take your required minimum distributions in your 70s. Another consideration for those with low risk of running out of money during their lifetime is whether or not you're bullish on your investments. Here's what I mean by this. When you delay your Social Security benefits, you would in theory have to spend down your investments during the years you're waiting to collect. This is, of course, assuming that you've retired and you've not yet filed for your benefits. If you're bullish on your investments, this may be an opportunity cost. To consider this, you would incorporate hypothetical investment returns to your break-even analysis. By assuming that your benefits would be reinvested and growing, you can gain an understanding of what it would take to truly break even when comparing different filing ages. Of course, it's also important to consider your health. If you have health concerns and expect a shorter than average life expectancy, it may be appropriate to file sooner than later. But it's also important to remember that if you're married, your spouse would likely be eligible for future survivor benefits. So although you may not break even should you delay your own benefits, your spouse would inherit the higher of the two benefits. So it may still be appropriate to delay regardless of your expected life expectancy. And finally, do you plan to continue working? As discussed earlier, if you plan to continue working while collecting benefits, you may receive significantly less in benefits during those years. In the case where you file early and continue receiving benefits, your benefits will increase once you've reached your full retirement age, but they will still be permanently reduced as you filed early. All right, so we've covered a lot so far, and I hope that you have a pretty deep understanding of your Social Security benefits. But if you follow the news, you've likely heard about the program's financial troubles. As it stands today, the Social Security Trust is projected to be depleted by the year 2034. And since the majority of retiree benefits are paid by the workforce's FICA taxes, there is expected to be enough in tax revenues at that time to pay roughly 80% of retiree benefits. The topic of Social Security is often referred to as the political third rail. This means that politicians might prefer to avoid the subject because it charges voters. It's a very sensitive topic, but with that being said, in my opinion, I think that it's unlikely in 2032 that politicians will be campaigning on letting retirees lose a fifth of their benefits. So the more important question may be, how will they fix the problem? And that question can be further narrowed down to whether they will tax current workers or take from future retiree benefits. My opinion of the best way to do this really doesn't matter, but it's objectively more likely to be some combination of fixes as opposed to one that targets a single demographic. So, how might your future retirement benefits be affected? Well, there are over 150 different proposals being put forth to reform the Social Security program. So, we don't know exactly how they'll do it, but what we do know is what they're considering, which allows us to prepare for different potential outcomes to ensure that our retirement plans may hold up regardless. Let's review the current proposals that would have the greatest impact on future retirees. The first category of potential reforms affecting retirees would be a reduction in the cost of living adjustments. A cost of living adjustment is when your benefits increase to maintain your ability to purchase the same amount in goods and services as they become more expensive over time. Of this category, a bad case scenario would be a 1% reduction in future benefit increases for retirees. This would fix nearly half of the 20% funding gap. So, in your retirement planning, you can prepare for this possibility by growing your future Social Security benefits by 1% less than you're growing your living expenditures. And by doing so, you'll be projecting greater spending from your assets, which will effectively stress test your retirement spending. If this potential change may increase your likelihood of running out of money, you may consider working longer. The second category would be an extension of the full retirement age. This has been done before under the Reagan administration when they phased in a full retirement age extension from the age of 65 to the age of 67. As of today, the latest full retirement age is 67, and there are proposals being put forth to extend this once again. The most aggressive proposal being put forth today is to gradually extend the full retirement age for those age 62 and younger today by 3 months per year until the year 2035, at which point the full retirement age would be 70. This would fix just under one half of the program's funding gap. So if you're in your 50s to early 60s, you can prepare for this by modeling how a later full retirement age might impact your assets over the long run. I believe that the greatest effect of this type of proposal would be in limiting the retiree's ability to earn delayed credits on their Social Security benefits. The third category of potential reforms would be the potential for higher taxes. Higher taxes would likely have a greater impact on the workforce by increasing FICA payroll taxes. It's projected that increasing payroll taxes by 1.9% on employees and another 1.9% on their employers would fix 100% of the Social Security funding gap. Although higher payroll taxes may reduce your ability to save leading into retirement, it would likely have less of an impact on the average person's ability to retire versus other proposals that are more geared towards reducing retiree benefits. And finally, another category of potential reforms being discussed is the changing of the calculation for the primary insurance amount. This topic is extremely complicated and beyond the scope of this presentation, but I don't believe it would significantly impact the average retiree today. Also, if you're concerned about a doomsday scenario, you could always model how losing a fifth of your Social Security benefits would impact your retirement. Although this would be a highly unlikely outcome, it couldn't hurt to see how your retirement holds up under this scenario. For those seeking peace of mind, this may be an exercise to help you feel better about your decision to retire. If you've made it to this point, feel free to schedule your complimentary consultation with me. On our call, we'll discuss how developing a one-time paid financial plan together may be of great benefit to you. If I don't feel that I can add value for you, I will tell you. In any case, if you agree with the notion that the best laid financial plans are those that are the least wrong, speaking with somebody who eats, sleeps, and breathes this stuff may be just what you need to gain the confidence that you're making an informed decision. I wish you the best of luck, and I hope to hear from you soon.